Hello, you're watching Dukascopy TV. I'm Thomas Taplin, and as almost all signs point to an invasion of Syria by the US and its allies in response to the alleged gassing of civilians that killed hundreds of people, the markets are bracing themselves for quite a bit of volatility. Well, joining me on the line is David Jones of IG. David, thanks for joining me today. You're the chief market strategist over in London. What's the mood like there ahead of possible military action in Syria?
I think it's maybe we're seeing something of a split as to how the markets have reacted. There's been some fairly expected moves in the price of gold, people looking for a safe haven. Clearly that whenever we have any sort of global uncertainty, one of the things people do look at for a safe home for their capital is gold. So that has been lifted somewhat over the past week or so. Probably the bigger move, though, is in oil. We've seen oil out to 2-year plus highs, trading up US crude oil around about $110 a barrel on concerns that, what any further military action may have to supplies around the world. But stock markets are just fairly calm. We've seen maybe some uncertainty, but nothing major in terms of volatility from a stock market point of view. It's all been focused on those two commodities.
Now, MPs and Prime Minister David Cameron have all been called back early for a meeting on this. As far as the UK is concerned, the economy has only just shown signs of growth. Surely teaming up with the Americans on this is premature, is it not?
I don't necessarily think that's the case. There's a classic market cliche where, unfortunate as it may sound, military action can add some benefits to the economy, but I don't think it's really maybe as clear cut as some of the military activities we've been involved with the Americans in the past sort of 10 to 15 years. I think there's definitely, this time around, we don't seem to have the weight of public opinion behind any sort of activity. David Cameron's already taken a step back from having a vote this week on whether we should get involved in Syria. That's been pushed back to next week. So I think maybe some of the, not procrastination by politicians, but wanting to take maybe a calmer look at this is having an impact on the wider financial community, and that's why we're not seeing too much of a reaction there.
OK, let's move away from the UK. I know my colleague Darren McDermott is looking at oil in more detail in our Commodities Corner interview today, but the price of oil has only just come down from its huge prices a few years ago, where they were almost $135 a barrel. By how much do you expect prices to fluctuate if we do see an invasion in Syria?
I think we'll see potentially fairly significant volatility if we do see military action. And actually, if I think whatever the outcome is, I think once we do know either way, you would expect a correspondingly significant move in the price of oil. At the moment, just in the last couple of days, the oil price has surged at its peak by about $5, which is a sizable move. It's almost a 5% move for the price of oil. We're already up from where we were just 4 months ago. It's trading around about $20 higher. I think if we do have some sort of action, I think what the initial reaction from oil will be to move higher. But the problem, I think, in trying to tie in a market move to an event like this is how much of it is already being priced into the market. If we look at oil a week ago, it was trading around about $105 a barrel. So when it's trading at 110, 111, is the market already pricing in that risk premium?
OK, let's finish off with a look at stock markets. I know you said not much has been happening, but the FTSE is dropping ahead of Syria concerns, as is the S&P 500 and Nikkei. Emerging stock markets are also down, but energy stocks have received a boost. Where would you be buying protection now, or would you be holding off altogether?
I think it might be the wrong move to take the strength in energy stocks as a sign of a bigger turnaround. If we look at maybe some of the major mining stocks in the last couple of years, they haven't really delivered great returns for investors. So I think we could be seeing just maybe something of a dead cat bounce when it comes to the mining stocks. If you look at the broader market, I think if you were really worried about a bigger negative market reaction, then clearly I think you'd want to be out of everything altogether, and you'd need to look at a safe haven like gold or the US dollar. But when it comes to individual stocks, I don't think we're going to see the market too troubled by what happens in Syria in the short to medium term. We've already seen over the past sort of 4 weeks quite a steep decline in stock markets around the world, really just in reaction to the global economy. So I think at the moment, I don't think there's that much downside left for stock markets. So I wouldn't be too concerned about moving into specific sectors ahead of anything happening in Syria. I think we could see a stronger bounce back in the markets overall in the next couple of months.
Okay, that's all we've got time for. Don't forget to check out my press review today, and I'll see you tomorrow for the last Targets in Focus interview of the trading week. Goodbye.